Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, the markets are tanking. Is this it? Is this the crash? We're going to tell you. Let's dive in.
Trade Genius.
Bob, really nasty day on Friday. It sold all the way into the very end of the day, and then even the futures markets continued to press down after the cash markets closed. So everybody, they're wanting to know, is this it? Is this the one? What do you think?
Oh, Phil, good to be back from vacation and back in our comfort zone of the bear cave. Yeah, it was really interesting. I think I talked about it in the room. I went on vacation, I think it was 8 days. And for the first 6 of those days, my portfolio maybe moved like $100. And I just got increasingly short. And then the last 2 days, just basically all heck broke loose. And we finally got our push down, which was really interesting is because, it was actually a normal OPEX week the way we trade it, Monday, Tuesday up, Wednesday, Thursday down. What really caught my attention was, and I even joked with you because I said, hey, I'm going to be traveling today. I bet this is going to be a consolidation day. And you said, hey, Bob, volatility looks too extreme here. I think we may dump. And I left. I kept my shorts on and I checked at the end of the day and I'm like, whoa, we made new lows. So
Right.
What's really scary to me is that we're really at an interesting support level. If you want to throw the first chart up, my view is Friday down, Monday down, and
Right.
the week after OPEX is technically a red week. So a lot of things are setting up here for, I think, a follow-on. And correct me if I'm wrong, Phil, there's also the flows that really, the iceberg with derivatives are negative to the end of the month. And I heard it even into the first week of November. So look at this chart here. This is our SPY chart. At the bottom, you could see that, I think I have it as a daily, is that, if not, it's a 4-hour. You could see where our indicators told us that positive flow that came up earlier in the week was failing because we started getting those warnings. You see those, like the red line with the yellow caterpillar was saying, hey, guys, if you're long, you better cut loose. And then boom, we got hit with a sell order on our system and just basically bought puts and walked into the weekend. But look at that level. If we break that 420, Phil, on SPY, I know you look at the futures. I like to look at SPY, is that I think it brings 404 into play in that area. And I think there's gaps down there, but that brings us pretty close. I think basically losing it for the whole year. And I just want to get your thoughts on that before we move on to the next slide. This is that really easy for you guys. You can short this thing. If it breaks 420, use your stop at 420 because if it comes back up, there's a failed breakdown. If not, there's clear air down to the next measured move, I think.
My take on this is that, one thing I like to do is what's the majority consensus right now? Majority consensus is, seasonality's been spot on for the better part of the year, really. And October is supposed to be a very bullish month, much like how July seasonally is a bullish month. So everyone's on the seasonality train. Well, you and I had talked about that because of the bond issuance that's going on, that we could very well break seasonality. And we have broken seasonality so far in the month of October. So everyone's looking at this as a double bottom. You didn't quite take out the lows, which would have been better for the market if it had actually stabbed through that low over there on the left. If it had done that prior to the market closing on Friday and then coming back up, I think that would have been a much healthier situation, because now what you might run into, especially as they always set up these moves going into the weekend, you could possibly have a gap down on Monday. And the reason why we're in a perilous spot too is because we're under the weekly 50 moving average, simple moving average on the SPX or ES, which is the futures, however you want to look at it. But when we're under the 50 weekly moving average on ES, that is a very bad place to be. And the market's very rarely, if you look at the market on whole, very rarely does it spend time under the weekly 50 SMA. And the way I measure whether we're in a bear market or not is if the weekly 9 crosses down through the weekly 50 SMA. And that's in the bear market course too, by the way, guys. If you're interested in that, you can check it out at tradegenius.co, because that course is probably going to help you out over the next year. But basically, we're almost there. And, it's going to probably take another 3 weeks if we don't recover quickly. And then we will have that death cross essentially. And then that's going to be down. So in terms of where we are with those moving averages, because that's giving you a relative spot for the market. And if you're in a bad market structure and you're coming down under those moving averages is usually a big fat red flag that we're going potentially into a bear market here. So the weekly 9 The weekly 50 going forward here is extremely important. The bulls have to recover those moving averages on a weekly closing basis, or this market is now in a position to go down quite a bit further. And I don't see a lot of people anticipating that. I think a lot of people are looking at a rally into the end of the year, and that's usually the setup that you need for things like that to happen. So while I don't know about a crash personally, I do think though you can start a bear market structure that's grinding down, and it slowly is showing everyone, hey, we're not making higher highs, we're making lower highs. We've done that twice now, and we're about to make another lower low. And so it's lulling the crowd into kind of like this complacency that actually by the time they realize what's going on, we're already pretty far underwater.
Yeah, and I call this. Remember, I said, Phil, I'm waiting for the Alzheimer's market to just slowly going away.
Right.
I think that's what's happening here. Look, 420 to 404 is a 40% correction, but it's going to feel devastating for people's portfolios. I know a lot of people, I'm not going to name names, that are being professionally managed. They're all underwater right now, and so us personally, because I stayed heavier in energy, which I defied the seasonality. September to November is supposed to be a weak period for oil, and it was not. And now we're sliding right back into higher seasonality for energy going into Christmas and January. And if we didn't get that lull, that's going to put additional pressure on the broader equities. But I want to throw the next chart up. I'm going to let you explain it because this is your ballywick more than me. But this is another line in the sand that should scare the heck out of people, Phil.
This is the other thing that was very interesting to me is the yen is almost back to 150. I mean, we're close. It's within 20 pips. So why that's important is because that's a well-known level that the Bank of Japan defends. And typically when the yen is up at 150, it's volatility for the market. Last time we were at 150 on the yen was last year, and we were basically at the market lows. So this market has done a really good job of bucking the yen move, but I think that's part of the problem why you got to be cautious here, because the yen's just shooting up. Now, if the yen breaks out of over 150, I think it's going to create some problems for the Bank of Japan. And I think, as we had alluded to in previous videos, that our issues, we may get systemic issues from the Bank of Japan, from that side of the ocean. So we're getting at a critical mass here in terms of where the yen is, because remember, they can't let the yen get out of control, but they also have a bond market now that is also on the ropes, and they're going to have to make a big decision here that's going to have ramifications for our markets, because I think what they're going to be forced to do is just say, we have to be hawks now. We have to let the interest rates rise on our treasuries. It's unsustainable for them. It's going to bankrupt them, but I think for now they got to keep the yen in check. Otherwise, they're going to have hyperinflation. So it's like, you got what's, lesser of two evils basically for them. The point of that is if they go hawk, then that's the last of the central banks that are easing. And that's it. No more easy money yen carry trade. So it's another bearish. That's actually a very significant bearish element for this market, Bob.
Yeah, it's crazy. And the next chart here, do you want to bring up the equal weight versus the Magnificent Seven?
Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
This one cracks me up. And this is why I always want to pull my hair out when the trolls tell us we're in a bull market, because all they see are the headlines, and they don't realize that most people's portfolios are not in SPY. Okay, that's not how it works. They have people spread in these different stocks and ETFs, and their portfolio looks more like the one at the bottom, which is equal weight. And Phil, correct me if I'm wrong, isn't that negative for the year?
It's negative for the year, and that's all you need to know, because bull markets, if you use the equal weighting, which a lot of technical analysis do, the guys that work for like the institutionals, they'll take a look at the performance of the equal weighting index, which eliminates the skew of the Magnificent Seven, right? Our modern markets are basically shuffling everyone into a very small basket of stocks, which is usually not the case in history, but it has been in the last few years. Even with that being said, the equal weighting should be in positive territory. So if you're not in positive territory, which basically all that's saying is the broad market is dying, okay? The broad stock market is dying, and you're being fooled because you have a couple of names that are holding the entire thing up. Well, that would be the equivalent of holding up a car while you're standing on wooden stilts that are made out of straw. So, eventually it's going to collapse.
Yeah, you're running towards a mirage.
Right.
And the thing about it, the Mag 7 are all in tech. And, if you notice here, Janet Yellen's chasing everybody into the bond market, and Joe Biden's chasing everybody into the defense contractors. And
Yeah.
so,
Yeah.
tech's not going to sustain here because money has to go where the flow is, and it's going to come out of tech. It's going to be a brutal comeuppance. Look, we are identically as we were coming out of the 60s into the 70s. The inflation outlook looks the same. The Middle East problems are there, and the Nifty 50 are now the Mag 7. And we had, you can expect inbound. I think we had 30 or 40% corrections in that decade. I think you're going to see a lot of whipping. And speaking of whipping, Phil, let's show this next chart. All you need to know about this chart is that this is the way the derivative guys are seeing the market. And so you see that green rectangle, it's pushed us into this zone, which is called negative gamma. And all you need to know about negative gamma is that moves are exaggerated. And you'll see basically makes the intraday action very, very whippy. And the other thing that you have to understand about this chart is the volatility index, meaning that's basically the measurement of how much protection is being put on or taken off 30 days into the future with puts and calls out of the money, meaning away from the current price. And that has now reached a number of over 20. And that means you're looking at moves that are 1.5% to 2% intraday. And if you have negative gamma, it just makes these moves even more exaggerated to the downside. So I look at that move here, and if we lose that 420, that means the market makers, and the dealers have to short the market to protect their position fill. And it just exaggerates these moves down, and it's going to become a vomit comet over the next 2 weeks. And most retail in this environment are a day late because of recency bias. Oh, the market's down, I better short it. And then they pop it. Oh, shoot, I lost more money. I got to short it again, go long again. Then they short it.
Right.
And eventually they just wipe you out, and the market just generally just keeps falling. So I hope I explained that simply enough, Phil. I know I get accused of talking in jargon, but I want you to go ahead and add some commentary to it if you want.
Yeah, and if you guys notice, I know sometimes dot plots can be a little hard to read, but if you notice the last close is where that rectangle is, that green rectangle, you'll see a little green diamond in there. So that's where we are. And basically what it's saying is that the more that you are entering into where all the red dots are, the slipperier the slope. Okay. And Bob's right. We're in negative gamma, and you saw the effects on Friday, I think, with the market, because what it ends up doing is if the market is in a negative gamma, it basically creates this magnetism for lower strikes on the S&P 500 options market. So you have two main options markets is the SPX, which is the index itself. You can buy options on the actual index, SPX. Those have negative weighting lower. On Friday, what we saw was, in particular, the other market is the SPY, which is the ETF for the S&P 500. That had very negative weighting to the put side at the 420 strike, and we ended the day at 420 and I think 89 cents or something like that. So all day the market, you can see the dip buyers trying to come in, but the overwhelming force was that the dealers that deal out these option contracts to you or whoever's buying, at the end of the day, they have to hedge that. What happened on Friday was you had a bunch of out of the money puts that started to increase in value. And that's a problem. And so as those things are starting to all of a sudden blow up and increase in value, the market makers have to then go short the market because those things are starting to increase in value to offset the situation that they're in. So they're trying to remain and have a neutral stance. This all happens in real time with algorithms, and the algorithms are trying to keep their books and their position neutral because they're just trying to make money on the sales of whatever they're selling, the spread. And so that's why we push down, because as you get to a big magnet like that, it creates kind of a self-fulfilling prophecy the closer you get to it. And that's exactly what happened on Friday. And that's going to continue to happen until the hedges come off that are forcing that mechanism to happen. And we saw a lot of that in the first half of 2022, which is why we kept saying, go back and look at those charts, because we're in that same environment, primarily because the long duration issuance from Yellen now has happened. She's pumped this market with the short stuff. You can do that because it turns around and becomes leverage collateral for the institutional traders, but they can only do that up to about 23% of the entire treasury book, and they've tapped that out. So why they chose to tap it out now instead of next year into the election, I don't know. Maybe they're going to try again. But for right now, they're tapped out. So now it's all long duration stuff. And so the Q4, what we've been saying is shaping up, is playing out now. And so I think the majority thinks we might bounce soon. I say, don't be surprised if this thing gets, will we bounce? Yes, but we might have 2 or 3 more days like Friday before we do. And then we'll get a bounce. And it'll probably, and the cycle is going to be violent. So you're going to have violent bounces up and then it's going to come right back down. I really implore you to study the charts from January to June of 2022 because I think we're in a very similar situation. I think the moves are going to be very similar.
Yeah, and Phil, and I think the banks were warned to lower their leverage on their books too. So that's another thing that's going to be negative for the market because they're usually long and they're trying to pump.
Right.
And so that's an issue. But look, we'll know when the bottom's coming in because we'll start seeing the week over week put activity, the open interest start to fall. And then we know people are puking out. So what tends to happen is that they buy puts to protect the position. And then one of 2 things happen is that they feel they made enough profit on the puts and they just take that cash off the table, or they close their position out and they don't need to hedge anymore. But either way, you get to a price zone where you start to see an open interest fall on the puts going into the future. And then a bottom is in. And then we'll get a violent reaction to the upside again. And then we'll hear happy days are here again. But all we care about, we let's look at this market a week or 2 weeks ahead. And there's not a wall of worry to climb here. It's basically the cliffs of Dover here. And they're not going to be able to get over it because everybody's jumping off the ship right now.
Totally agree. Guys, let us know what you think about the stuff we presented here today. Do you think that we are going lower? Or do you think we're going to bounce and it's going to be happy days until December? Let us know. Otherwise, guys, thanks for watching. Check out our stuff over at tradegenius.co. If you want to take the bear market course, that's over there too. Just go in there and check it out. We have that available. Thanks again. We'll see you guys on the next video. Bye-bye.
Trade Genius.